Alright. In this video we'll be going over just some more concepts from ICT, or Inner Circle Trader. So this is actually his whole strategy. So my friend Daryl, he helped me kind of learn the strategy, and he's kind of been showing me how the strategy works, and I want to turn this into an EA or expert advisor bot sometime soon when I have some more time, so I'm just kind of doing it in small chunks. So this is the whole strategy. Everything's here. Some of the stuff may be a little confusing, so it's a very advanced strategy. I'm not gonna lie, it's one of the most advanced strategies I've seen. It's completely price action, so as you can see there's no indicators here, there's not even any moving averages, not even volume or anything, so it's just a naked chart. That's all it is. So in programming terms, we basically have, so as a programmer, what do you have access to as a coder? So you have access to the open price. So let's just pick a candle. Okay, let's just pick this blue one right there. If you can see the mouse. So the mouse is here. Let's see if I can zoom in on that. This candle here, I probably could draw. We're just gonna not draw right now. So let's just say this is open price, because that's how a candlestick works. It opens here. If the price closes higher, then it's a green candle. In this case, he changed the color to blue. I think this is blue and black or blue and red. I think it's blue and maybe navy blue. So we have like a sky blue and a navy blue color, where the bullish candles are, or the green candles are, in this case, sky blue or light blue, and the red candles are navy blue, or like a plum color. So like purpley navy blue or something. Okay, so if the candle starts here, obviously if it closes higher, then it's supposed to be a green candle. The low we can't really see, but there's a little tiny bit of a low there. That's just a speck tinier less than the opening of the candle. So we have an open, a close, a low, and a high. So the high is this point here, and that's the candle. So when the price closes here, the next candle starts there. So those are pretty much green candles. For red candle, the price starts at the top rather than the bottom, top of the body part. Yeah, so it can go up or down at first, doesn't really matter, but if it closes lower it becomes red. So the highs here and the lows there. So we have four things. We have an open, so I think, have you ever seen these on TradingView? At the top here they'll have, like, if you move the crosshair around, you'll see that it says like OHLC, open, high, low, close. So that's what it means. So that's what we have access to as price action. If you want to code a price action strategy, that's what you have access to. Okay, so now how does ICT strategy work? So I'm going to be going into some details here. Okay, so let's look at this point here, where that circle is drawn there. So we have a circle there, and that goes across with a horizontal line all the way across that way. So let's pretend price actually didn't rise above or too high above that line where that high was to the left. So now if you have two equal highs, most retail traders will see that as a double top. So I'm sure you've seen that before. So when it's supposed to touch like a resistance level or a double top level, the price is supposed to continue down. Or some retail traders may think that way. In another case, if the price travels above that horizontal line, or maybe, for example, closes above or something, they will think that it's a breakout, so that the price is actually breaking out, as in traveling higher. So if they short the top, they get stopped out. If they try to go long for a breakout, they may get stopped out as well. So that's what he talks about. But also what he talks about is pretty much the concept, I guess, that he created, or that he talks about, is pretty much so when banks want to sell, they want buyers, or they need buyers to sell to. So that's called a liquidity sweep. So he talks about that in his videos. I think some of his stuff might actually be paid. I'm not sure if that's correct. If his full, I think some of his mentorship might actually be fully paid for. I'm not sure if that's true. But he does have a lot of free content where he discusses, or he talks about this stuff for free too. So in this case, banks want to sell the retail buy side liquidity. So when buyers want to buy here, retail traders or whatever, retail investors, they want to buy here. So he talks about banks wanting to sell into that. So they'll sweep above the equal high, which is this area here, where this horizontal line is. Well, so when it comes up above here, then they want to so when the retail investors actually buy into that for a breakout, the banks want to actually sell that. So they want buy side liquidity first to sell into. So that's what he talks about. I haven't seen all his presentations, just my friend was kind of explaining this to me. I've thought of this before. For example, if you have like a moving average or something, and like the price travels very high, I had a strategy that worked pretty much where you'd sell when it's high, when it's like very, very high above. The average is kind of similar to this, but it's a bit different because this is just like it's just solely like price action. So pretty much that's what it is. So what the banks are trying to do is they're trying to trick the buyers. So when they sell, when the banks sell, it causes the market structure shift, or MSS. And then that's the confirmation along with the FVG, or the fair value gap. So basically, so hopefully you guys understand. So it's like banks want to, so once banks see a level, once they see buy side liquidity, they want to sell into that. So they're probably trying to sell around that very tip there. They want to get in as early as possible. They want to pretty much just sell at all the buy side. They want to sell on top of the buy side liquidity that's coming in from the retail traders or investors. So basically, they just want to take the buyer's money for themselves. They pretty much just want to take they want to take all the retail money and sell into that. And obviously, banks have more leverage they have more liquidity, they can control the market so that they want to sell into that. Because imagine like billions of dollars kind of being shorted here, or even more than that, right? Trillions even. And that's kind of overpowering all the retail liquidity, which could be just a fraction of that, maybe just like 100 million or maybe a billion compared to like a trillion or something like that. So they have more they can move the market the way they want. So that's what they kind of do. So this can happen different ways on different time frames. In this case, it's just a 3-minute example. This is happening all the time, like around the clock. When you're sleeping, the algorithms are always moving. Even when the banks are closed, they have the bots running. Now they have AI strategies coming out and all that. They have like, for example, like Python models analyzing this and seeing like how it works. So they're kind of trying to create a repetitive algorithm from just like through like artificial intelligence, which is very complex. We'll be discussing that, probably the last thing on this channel. So pretty much, it's actually probably not that complex. There are some Python, well, like the models, there's a lot of math involved, so we'll try to get to that at some point later on. There will be artificial intelligence on this channel. It will be coming out later, probably at the end. So not right now. So that's pretty much it. So I'm just trying to think about any more. So that's a liquidity suite. So there's pools of liquidities at different levels. So that was at one level. So why is that a liquidity sweep? Okay, so that was a liquidity sweep because it was the most recent high. So the most recent high was taken out. Retail investors went long. Then there was a market structure shift. So let's talk about the market structure shift. And I'll just come back to see if there's any points that I missed about that. Just to see if there's any more topics, to see if there's anything I missed about the liquidity sweep. So for the market structure shift, so we have this. We have pretty much. What is a market structure shift? So the market structure shift pretty much is it's a low. There's an initial low, and then there's actually no. Where's that's the low? Yes, so that's yeah. So there's actually one low there. So it's gonna be a first low after the liquidity sweep. So the liquidity sweep happened here, right there. It was actually the first high. I think it was just the first high above. So the first high above there, and then we have the first part of the market structure shift. So the market structure shift has one low. Then it comes back up in here, pretty much just back up there. Travels up. Then we have another low there. Okay, so I have a definition for the fair value gap as well. So after the market structure shift, so before I think I talked about a close, so I'm actually, that's a good price. I think I'm gonna just change the title of that video, if you've seen that video, just to price action concepts, because it wasn't actually the market, it wasn't the, he uses the lows, I believe, just the lows. He doesn't actually want, it doesn't actually have to be a close, like this, the actual close was like this one there. There's the first close below there is like there, and then there. fair value of app could have been there. It's pretty much, that was it. So it's similar. It's very similar though. It was close. But I think he just uses the lows themselves. He doesn't use the close price. So you can try different things. But the actual definition, do I have the definition? I do, okay. So my friend Daryl, he's been trying to put this into like English so I can understand to actually start coding this. So I have the liquidity sweep kind of mapped out. How the code's going to work for that. It's kind of tricky. And then there's going to be the market structure shift. So the first part is liquidity sweep. So you can think of number one for this, for ICT's strategy. I don't know if this is his only strategy, but for this strategy, like the liquidity sweep, market structure shift, fair value gap strategy that he claims that the banks are using, pretty much, well, I'm sure you've heard of liquidity zones if you're a price action trader or investor, whatever. So it's similar to that. A lot of the theories are very similar, so I found it interesting. I found it very interesting. So like to actually code it into an EA and see actually how it does 15 years back would be really cool to see if it's actually any good. But anyways, pretty much, so the fair value gap strategy is, so after the MSS, so if you can see this bubble here, after the market structure shift, the next candle comes up into the FVG for short entry. So there's one here and there's one there. They're two separate ones, I believe. So for this one here, remember, if you've ever heard ICT speak, he talks about a 3-candle impulse. So a 3-candle impulse, which really means it just takes 3 candles. So pretend this is candle 1, candle 2, and candle 3. So these are the 3 candles right there. Okay, so there's a little bit of a part. So there's actually, okay, so I think it's actually technically supposed to be 4 candles. I think that's what my buddy's getting at here. My friend, he's saying that it's 3 candles, but then he's saying that ICT also says that the entry isn't on the third candle. So if we have 1, 2, 3 candles, this is the 4th one's entry, and I'll tell you why. So an FVG, or otherwise known as a fair value gap, is between the 1st and 3rd candle. So this is the 1st candle, that's the 3rd candle. So if we were putting this into, actually I'm not sure if all the viewers will understand this, so I'll just probably skip over that part. But okay, so a fair value gap can happen anywhere, it just doesn't have to happen after an MSS. In this case it is, because the strategy pretty much it uses the fair value gap after the MSS. So in this case, whoops. So what we're looking for is either the low, I think it's actually the low, between the low and the high. So 1, 2, 3. Now that gap is between 3 candles, where that gap is between this low here, if you can see the mouse, so it's between candle 1 or candle 0 and candle, well, you guys, because in computer science they start at 0, but I'm just going to say, let's just start at 1 just to make this simple for people who want to understand. So we have 1, 2, 3 candles here. So for candle 1 we have, so it's between the low of candle 1 and the high of candle 3. So it's that's the gap right there. Now the fourth candle is supposed to actually touch inside the gap, and that's the entry. You want to enter at some point in the gap. I'm not sure what the exact point is. That's up to you. We'll probably get into that coming up then, what the exact point can be. If it closes higher, you'd probably want to just close that one, that it wasn't actually a successful FVG. Or you probably wouldn't want to enter at all, something like that. You'd probably want it to be like 50% above this line, which is an extra. It's an extra calculation in itself. So that's pretty much just it. And then the target is the last sell side liquidity low. That's confusing, but pretty much the sell side liquidity. So this was a buy side liquidity. It gets swept. So we want I think we want the most recent low. How would that even work? I'd have to think about that. But for example, the most recent low is kind of like here. That might be too greedy. You probably want you could have other things that you're looking at. But I think what he looks at is the sell side liquidity for the target. So actually there's another FVG here, but there is no liquidity sweep and no MSS. So we'll have to. Whoops. Sorry. Happened there. So I'll have to confirm that later on, but that's pretty much just it. So I'll probably just leave you guys with that. So hopefully you guys understand that. So this one hopefully was more helpful than the other one, so you kind of have something to go off. Some better concepts here. Let me just see if I missed anything. So first, there should be, just to recap, there should be a liquidity sweep, or just to summarize. So we have a liquidity sweep, so above the equal highs. That's a sweep. I think that part is pretty clear. So the profit's supposed to be near the nearest swing low. So we'll get into that later on. So once again, the banks need all the money they can get to sell their large positions. So they want to sell into buy-side liquidity once again. So this is kind of like a buy-side liquidity pool right here that they want to sell into. So we want so pretty much they're looking for buyers above like a double top or equal highs. Equal highs makes more sense, well, in programming terms, but pretty much they want it to buy above a double top area. They want to sell into a double. They want to sell people who are actually trying to buy a double top buy a breakout. That a double top turned into a breakout. They're trying to sell above that equal high. So hopefully I didn't confuse anyone there. Sorry about that. So it thus tricks the market, and basically they take the liquidity money from the retail investors back to the bank. So that's pretty much it. So thanks for watching, guys. If you guys liked the video, you can like and subscribe to support the channel for more programming and investing tutorials. I'll see you guys in the next one. Take care. Thanks.